Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 56 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think can be very helpful for you in your financial life and your push towards financial freedom. Today, what we're going to be talking about is refinancing your mortgage. With rates as low as they are today on mortgages, then it's just a natural thing to want to bring up the question of whether or not you should refinance your home. And so today I hope I can speak to that issue and see if there is a reasonable basis for you to do so or not based on your particular decision. But we're going to talk about what refinances are, how they work, how costly they are, and whether or not you should get one at all. Before we get started though, if you could go down below, hit the big red subscribe button. Also like this video and leave me any feedback in the comments as the video goes along. If you have any questions or comments for me, just leave them down there. If you're listening on Apple or Spotify podcasts, make sure that you subscribe there and leave me a review on either one of those sites. That would be very helpful and much appreciated. Also, follow me on social media at MNO with Dylan. That's a really good follow because I put out a lot of good content every single day. So maybe you can learn a little bit from that as you learn from my videos throughout the week as well. And then last but not least, if you need some one-on-one financial coaching, if you need somebody to help you create a financial plan for you in your particular life circumstances, then I would be more than glad to do that for you. That's a service that I offer. But if you want to sign up for a financial coaching session, then go to my website, www.mnowithdylan.com, and click on the Work with Dylan tab, and we can choose a financial coaching session that would work best for you. And we can begin working together one-on-one, creating that plan that'll help you walk through your financial life. So what is refinancing? Well, refinancing is nothing more than the process of getting a new mortgage on your home for one reason or another and changing the terms of the mortgage that is currently on your home. And you might be thinking of refinancing for any number of reasons. You might think to refinance because rates are lower. You might want to switch mortgage companies. You may just want a lower house payment. You may want to get cash for a big purchase. And we'll cover all of these particular possibilities in today's video. But don't worry, refinancing does not mean that you end up with two mortgages. No, the refinancing process pays off the original mortgage and refinances it to a new mortgage that is standalone and separate. So don't think that this is like a Heloc or a second mortgage. This is something different, and it's a different process, and it's something that can be right for people if they fall into certain categories. When you want to refinance, you want to shop around with loan providers the same way that you did when you got your original mortgage and figure out which has the best terms and which will allow you to benefit the most from the refinance. That said, there are some requirements that must be met in order to refinance for most lenders. And so some of those have to be the following. So you have to maintain your original mortgage. So lenders need proof that you've maintained and paid your mortgage for at least 12 months before they'll consider your loan for refinancing. They're not going to refinance a loan that you just took out. Then equity. You'll need to show that you have at least 10 to 20% equity in your home. Also another way that the bank can know that you're not just constantly refinancing. You're probably doing it for a reason. And then income. You have to prove that you have regular income, and they look at your debt to income ratios and all that kind of stuff that they looked at in the typical mortgage underwriting process, kind of like we talked with those different types of mortgages last week. They will look at those debt to income ratios for you and just make sure that you can pay your bills and any debts that you may have. And if you follow what I teach, then when you're going to purchase a home, then you won't have any debts, but maybe refinancing, if you already own a home and you're beginning my plan, will allow you to pay off your debts faster. So this may be a relevant thing for you. And then lastly, they'll also look at your credit status. Now, obviously, most individuals refinance for the lower rate that they can get on the refinance. Well, if that's not a benefit that you can get, then it's typically not a good idea to try to refinance, because you don't want to refinance with less favorable terms unless there's a secondary reason for doing so. But if you are looking to refinance, obviously you want that lower rate. Well, you likely need to keep at least the credit that you had previously, if not better credit. Better credit may be a reason that you decide to refinance, because you can get a lower rate with the better credit, or just because rates have fallen and you've kept the same credit score as you did previously. But they will look at that in this process. So in the most basic terms, you'll want to refinance when you can make a less than desirable mortgage into a mortgage that is more desirable and more beneficial to you. Now, the issue, and the reason that you wouldn't just refinance every time that there's the ability to get a lower rate, is that refinancing is costly. Just like with your original mortgage, refinancing does have closing costs attached to it. And so what you are forced to do then is you are forced to do a break-even analysis of refinancing your home. So you have to determine, based on the cost of the refinance and the perceived benefit to you over a certain period of time, whether or not the refinance is worth it to go through that process and get a new mortgage. Because sometimes, even if you can get a lower rate, making back the money that you're going to spend on the refinance doesn't happen overnight. And so it may not be something that's extremely beneficial to you. Typically, if you have longer on a loan, it can be more beneficial. It's all just going to depend on what your rates are and how long it takes to recoup the money that you pay out in closing costs. So I say, just in general, the idea of refinancing tends to work if you fall into one of these four different areas in your particular life. So one, you have an adjustable rate mortgage, or an ARM. The most common are like the 5-1 ARMs. If you have one, you know exactly what I'm talking about. I'm not going to dig into that here. But if you have an adjustable rate mortgage, then your rates being adjustable is not too beneficial to you over the long run, because you can have spikes in interest rates, and that was a big issue during the housing crisis back in 07 through 09. So that's a particular place where you're going to want to look at things and go, well, maybe my adjustable rate is not what we want. Because typically what ARMs do is they start with some fixed rate, some short-term fixed rate that they offer you. And then after they give you that period of having a fixed rate, then your interest rate is adjusted relative to things like LIBOR, which is the London Interbank Offering Rate, right? This is just some benchmark rate that follows the economic climate and follows how interest rates are generally. And so the risk is then given to you. It's transferred from the lender to you as a homeowner, and then you have the risk of interest rates changing. And that can cost you a lot in the long term, and can be a good reason that you would want to refinance, especially refinancing to a fixed rate mortgage. Then another good reason to refinance would be if your mortgage is longer than 15 years. We've talked about how we don't like the 30-year mortgage. We've talked about how the 30-year mortgage is extremely costly and is something we should not be taking out on a regular basis. And given that that is the fact, then we want to keep with my suggestion of the 15-year or less. So if you do have a 30, as we've talked about previously, and the interest rates are really, really similar to the 15, then just pay the 30 like a 15 if you have the discipline to do so. But if the interest rates differ greatly, then this may be a really good chance for you to refinance to a 15-year mortgage and pay your home off quicker. That's the whole point of all of this, is we want to pay our home off as expeditiously as we can, right? Because what are we trying to do? We are trying to get to a point where we either have a shorter length or we have lower rates. In both cases, that's going to decrease costs towards interest, which is what we are not trying to pay. We are trying to earn compound interest in our investments, not continue to pay interest on loans. So it's going to decrease our long-term interest, and that is going to do us the most good in our lives of reaching financial freedom and getting our house paid off early. Then obviously something that I brought up earlier as a primary reason why one would consider a refinance is a lower rate. Just you have a high rate mortgage and you want to get a lower rate mortgage. And that is an extremely valid point. But you want to make sure that you can find a refinance that's going to give you 1 or 2 or more percent of cushion between what your current rate is and the rate that you're going to get in the refinance. And the whole reason that you want that cushion there is so you can actually make money on the refinance. That way you can actually save money because like we said earlier, there are those closing costs. So when you're doing your break-even analysis and you let's say you were only saving, 0.25% or 0.5%, it's going to take time in order to pay back the interest that you're trying to get rid of with the refinance, and it may not ever happen given how small a spread may be. But if you get a substantial spread on the two interest rates, the one you have and the one you are going to get in the refinance, then it can be a really good idea to go ahead and refinance down to that lower rate, thus decreasing your costs in the long term. Because again, that is our goal: decrease your costs. And in that particular case, you want to make sure that you plan on staying in that house over a long period of time if you are deciding to refinance it to a lower rate. That way you can make up those closing costs, because it would be useless and actually a negative impact if you did a break-even analysis and said, okay, it's going to take 3 years to recoup the closing costs and then I'll be on the positive side of the refinance. But then you decided to sell your house and buy a new one within that 3-year period. Well, then you'd be paying closing costs on a new home. That doesn't make any sense at all because then you would have never recouped what the refinance was supposed to be for you. So doing some long-term planning is extremely important in this particular decision-making process. So just make sure that you're doing that and understand that it's not as simple as I can get a lower rate. It's I can get a lower rate and this is going to be a benefit to me in the long run. Because in the short run, it would obviously be a negative, it would be a negative event given the closing costs that are associated. Now, this fourth and final reason why you may want to refinance your home has something to do with something we've talked about previously, and that is Helocs, or also known as second mortgages. Now, we gave the suggestion that if the second mortgage was more than half of your annual income, then you would go ahead and put it on the part of the financial action plan where you are paying off your house early. That way, you're not being bogged down and not able to invest and not able to build a good emergency fund by a large debt amount. So if this is the case and you did lump that with your mortgage, then it may be smart to go ahead and refinance that second mortgage along with your first into one mortgage. What this can do for you is get you a favorable rate on both. So looking at the rates, and you would still do a break-even analysis and make sure it was beneficial to you. But typically that second mortgage would have a higher rate than your typical first mortgage. Therefore, you should be able to get something that's a little more favorable for you. But just remember here, I don't want you to forget that if you are having a HELOC or a second mortgage that is less than half of your income, then remember that that is going into your debt repayment plan. You are not supposed to be doing that once you get into the paying off your house early. That's not supposed to get lumped into that step if it is less than half your annual income. But if it is more, then we can definitely do this. Just make sure you follow that rule. Otherwise, what you're going to end up doing is just deferring a small debt that you can go ahead and pay off in a reasonable amount of time. So I don't want you to get too bogged down in that, because we have covered that previously. But just know that this is a viable option if you want to go ahead and get those payments lumped together and hopefully decrease your costs, especially in the break even. So let's talk quickly about the costs of refinancing, because it's not just closing costs, but that is a big part. So let's talk real quick about the costs of refinancing. So Depending on your lender, the home's location, all these different factors, then the refinance can cost anywhere between 3 and 6% of the home loan amount typically. So if we're talking a $200,000 home, then you're talking anywhere from $6,000 to $12,000 in closing costs. And so this is where we play into your break-even analysis and say, are we going to make up these costs in a reasonable amount of time for it to be smart to go ahead and refinance this mortgage? Now remember that refinancing costs typically do not take into account property taxes, mortgage insurance, homeowners insurance, because all of those were taken care of with your original mortgage. Because you have to remember, we are revising the original mortgage here. We are not just starting completely from scratch. You already have taken that mortgage out. You are simply refinancing that original mortgage to different terms of the loan. But things that are included in refinancing costs are things like the application, the home appraisal, the title search. Then there's the home inspection fee, the lender's attorney review fee, the origination fee for the loan, and then the points fees for the loan. So you may not be able to avoid all of these costs, but mortgage points fees can be taken care of, but it's not always that case. So those are all costs that can fall into line with the refinancing of your home. So if you want me to give you an example of what a refinance break-even analysis would look like, let's just do something really simple with simple numbers. Let's say your closing costs were 3% on a $100,000 mortgage. Now I know that's a lower amount, but if you only owe $100 still on your $250,000 house, then this could be something that you're looking at. So let's say 3% of $100,000 refinance mortgage, so that's $3,000 in closing costs. And let's say your renewed interest rate is 1% lower than your previous rate. Okay. And if we look at how much that 1% reduction would save you every year, it would take around 3 years, obviously, to make up that $3,000, because $100,000, 1% is $1,000, right? You get the picture. Okay. So once you've made up the closing costs, you can enjoy the benefits of the lower interest rate till the end of your mortgage term. But it's not always that simple. It's not always that straightforward. Let's say that we're refinancing $200,000 at 6%, so that's $12,000, and you look at a 1% annual difference in interest rate. Well, if we're trying to get a loan that's 15 years or less and we're trying to pay our house off early, that is not going to be beneficial to us. We're not going to be benefited much by refinancing. So we may simply choose to not refinance in that case, and that's perfectly fine. But that's part of what the break-even analysis would look like in that case. So what can refinancing help you do? Well, if you're decreasing your housing costs, if you're decreasing the costs that you're going to have in your home month to month, then what does it give you room to do? It gives you room to give more. It gives you room to invest more. It gives you room to spend more on things that you want to spend money on. So it allows you to maintain that financial balance that we've talked about time and time again. And it's going to allow you to push harder to get out of debt, get out of that mortgage as quickly as possible. That's the whole point. We just want to get out of the mortgage as quickly as possible. And that will allow us the financial freedom to do what we want with our money, to do what we want with our income. And that's what a refinance should help you to do. Refinancing can also be really helpful in taking control of your monthly bills. So let's say you are in a place where you are in debt and you already own a home, although I talk about how that's not the smartest thing to do, but let's say you're already in that place and that's where you're starting from. Okay, well, if you're in debt, you own a home, well, it may be smart for you to refinance, thus decreasing your housing costs. Therefore, you can spend a little more time on your other debts. You can spend more money on paying off those other debts to get you to a point of financial strength and strong financial footing moving forward. Because if you don't have your debts paid off, then you're going to be working with a really tight household budget, and especially if you have high housing costs. So decreasing your housing costs in that way can be beneficial to you to get out of debt in a shorter amount of time. But let me pull no punches when it comes to saying that there are times when refinancing your mortgage is not a good idea. And some of those are the following, because you would like a new car, or you want to remodel your kitchen, or you want to, pay off your credit card bills, or things like that. What that would be doing in a refinance would be wiping out your home's equity in order to buy things that you want. So this is no different really than taking a Heloc in order to do this. You should maybe taking that at a lower rate. So this is why I said not to do this previously, right? I was saying we don't want to be dipping into our home's equity in order to just purchase things or in order to pay off other debts or things like that. The refinance should not be necessarily refinancing the entire value of the home, because if you are doing that, then yes, obviously you're going to get a lot of money in your pocket, a lot of money in your hands, because you have equity in the home, and you would be able to maintain and keep that equity and use it for other things. But that's not a smart thing to do. That just means you're going to have a full mortgage to pay, and that's not what you want. You don't want to be doing that for the reasons that I laid out in the Heloc video, the video about home equity. And you can go back and look at that. I'll put that here above, and you can go and take a look, and it will, make clear that you do not need to be borrowing from your home's equity. And a lot of people do that when they refinance. They refinance in order to do something like that, but that's not necessarily a smart thing to do. So I caution you against it. I caution you against getting into this place where you feel like the equity in your home is yours to just pull out and do with as you wish. No, we want to pay our homes off and leave them that way. That way you actually have income that you can keep, and you're not having to reach into these places like your home equity in order to take money to do things that you want to do. You can just pay for them in cash because you have the money to do so when your house is paid off. And let me also speak to the fact that if you are currently, let's say, out of work, or your hours have been cut, or you've been furloughed or something during the coronavirus, then what you have working for you at this particular time is that depending on your situation, you can have your mortgage payments lowered or put on hold for up to 12 months. And what this can do is this can help you to free up some cash in order to do the things that you need to do and to maintain your household in this time of economic hardship. And the reason that I bring this up is it may not be necessary for you to go and refinance your home. It may be because those types of programs might not be available to you, but you would want to check. You want to make sure that they are or are not available to you. That way you can make a better informed decision and not spend the money to refinance when it may not be absolutely necessary. So just take that into account when you are trying to make these decisions. I know this can be a hard time to make really good decisions, but put you and your family first. Try to make the best decisions that you can, and you can always reach out and ask me questions. Like I said, you can leave them down in the comments below, or you can sign up for financial coaching in order to learn more about this process and how maybe you can keep from refinancing and keep from pulling out of your home's equity in order to maintain the lifestyle that you think you can live until you get another job, or you can just keep the boat floating right on down the line until you can get yourself on firm financial footing again. So when it comes to refinancing a loan, I know there are a lot of moving parts. There are a lot of things and considerations to make, and there's some math to do with a break-even analysis and all of these different things. But I hope that I've made it a bit more clear as to why you should refinance if you have a valid reason to do so, how refinancing actually occurs, what the costs of refinancing can be, and how those can impact your decision making. Because you must know that this is not just a switch for a lower rate type decision. This is obviously a break-even decision that has to be made with some care and some just simple analysis. So make sure that you don't jump into a refinance when you shouldn't. Make sure you're not refinancing for the wrong reasons just to pull out home equity, and make sure you really can benefit from the refinance and really benefit in the long term by paying off more debt, or by investing more for retirement, or giving more, or being able to do things with your family. But just don't do it in the wrong way and for the wrong reasons. That's all that I implore you. But hopefully I've made it clear how to do it the right way and for the right reasons. So hey, don't forget to subscribe to my channel. Hit the big red subscribe button. Like this video. Leave me any feedback that you would like in the comments if you have not already. Also, if you are listening to this on Apple or Spotify podcasts, make sure that you subscribe there and leave me a review. Follow me on social media at MNO with Dylan. Like I said previously, that is a really good follow, and you will be able to get a lot of just tips and tricks and knowledge that I provide for you there. And then again, if you need some one-on-one attention, you need one-on-one work in creating a financial plan that would work for you, then we can do financial coaching sessions, which I offer, and you can sign up on my website at www.mnowithdylan.com/workwithdylan, or you can go MNOwithdylan.com and click the Work with Dylan tab and pick the financial coaching session that works best for you. And we can begin to create that relationship and get you on the right tracks as far as heading towards financial freedom. So tune in tomorrow as I talk about the decision to invest more or pay more on the home. And this is a big argument and conflict that comes up time and time again in personal finance circles. So we can really see, what I feel about it and how I think you should go about balancing these two big things that need to happen in your financial life. So thanks for tuning in to this episode of Money's No Object. I am your host, Dylan Howell. God bless.